everyone. Welcome everybody in today. Welcome everybody. We are getting started here in just about 10 seconds. For those that don't know, my name is Brett Swartz, founder of Capital Gains Tax Solutions. And every Friday we are hanging out with you on YouTube Live and on Facebook, talking about the best ways to build an exit plan when exiting. And today's topic is the most vetted tax strategy your CPA has never heard of. But before we dive into that, I want to do a little video intro. So here we go. It shares. Let's see if it shares here.
Are you telling me that you have a way to defer the tax situation there? Is that what you're telling me?
Yes, absolutely. Yes. And so the first one I was referring to is a 1031 exchange, which only applies to investment real estate. The second one I'm referring to is called a deferred sales trust.
A real eye-opener to see that there are ways that people can use the regulatory framework, if properly structured, to invest 1031 exchange dollars in things that you would not think were like kind to what they exited from. So it was very impressive. I got to say, you are the first one I've seen pull this off, and I'm pretty hesitant to believe in a lot of these kinds of things. So it's a major feat for me to say, wow, this actually really worked, and it was really cool.
1031 is a way to shelter your income when you sell the thing. The DST is a way to avoid the 1031 and not have to suffer the time penalty.
Our career and during different tax periods, we've seen, these tax avoidance, tax minimization, offshore, all these different strategies undertaken to minimize or avoid taxes. And then I can tell you that, some of them are just not worth the trouble. And so I was skeptical. Admittedly, I was skeptical. I thought, oh yeah, here we go, another one of these, right? And then they say, no, it really is different, right? So look more closely. We looked more closely. We had, honestly, 2 years of conversations. 2 years. Now we were being due diligence at the same time that we were doing due diligence, but 2 years is a long time to be, sort of flirting with the idea of and getting to know the people and getting to really understand the transaction. Yeah, long story short, we got comfortable, although we are not tax attorneys, lawyers, or estate planning attorneys, that at least, from an investment perspective, that, it made sense to sell a highly appreciated asset, get liquid, hold that in this type of a deferred or installment sale type of instrument, and then just be in a position then to do the most important thing. I'm probably stealing your next question, which is time. They say, well, you can't make more time. You can. The deferred sales trust, in a way, allows you to lengthen the investment time horizon for those assets after getting liquid, but before having to feel the tax impact. And from an investment manager's perspective, time horizon is the most important element in investing.
All right, everybody. Welcome. So happy Friday to everybody. My name is Brett Swartz, and I believe everyone needs a coach in every area of their life, but especially if they're looking for ways to exit and build wealth in a way that defers capital gains tax and has freedom, creates freedom for you. And so if you're watching this, either it's for yourself or maybe for one of your clients, we believe most people don't have a great plan in place and or a flexible strategy to help them exit in a way that actually achieves where they're trying to go. And so every Friday we're diving into live deals that you might have and or your client might have, and talking about frequently asked questions and helping people get comfortable with the deferred sales trust, get to know, like, and trust us more and more as we explore what this can do. By the way, there's other options as well. There's 1031 exchanges, there's Delaware statutory trust, there's donor advised funds, there's charitable remainder trust. There's different strategies out there that could be the best fit for you. And hopefully you're also going to get some clarity if those strategies are going to work well for you, depending on what you're trying to achieve. And so I'm also joined by strategic alliances and some business partners here. We have Jake Miller. He's the certified financial planner. Jake, how are we doing today?
Doing wonderful, Brett. Glad to be here. It's another fantastic Friday. I'm actually calling in from Amsterdam, so across the ocean.
The coolest, one of the coolest places, man. Well, that's cool. I've never been there before. At least I've heard. A little bit can get a little bit crazy, but I don't know. I've never been, but hopefully you're keeping it PG, right there, Jake.
So far, all I see is the nice green canals with the city and, fantastic weather, really nice people.
Good, excellent. Pierce York is also with us today. Pierce York, how are we doing, brother?
Doing great, man. Excited to be here. Ready to get after it.
And Pierce helps to co-host the podcast as well. He was just at the ICSC conference in Las Vegas, commercial real estate conference for mostly retail investments, making some contacts, which we'll talk about here as well. But before we go all there, we're gonna kick off with today's topic, right? Which is the most vetted tax strategy your CPA has never heard of. In fact, this might be the biggest reason people either hesitate and or maybe dismiss the deferred sales trust at first, is because their CPA hasn't heard of it and or they don't believe it's been vetted. And so I'm going to try to give you guys some context and some facts. Each and every single day we are facing this. And we do hope at one point that we'll close enough deals and have enough of a track record that this will become a foregone conclusion, like the 1031 exchange or like the IRA or like a 401k, and that if he's properly structured and set up within the guidelines that have been laid out by the creator of the deferred sales trust, that we can do this. And within the laws that are governed within the tax code, it works every single time. In fact, it's batting 1,000 right now. It's never lost. It's kind of like getting to the plate for baseball game and just hitting home runs every time. And that comes with not just a couple transactions over a couple years, but close to 30 years now, about 27 or so, close to 30 years of a track record with a tax code going back around 80 or 90 years, being IRC 453. As well, over a dozen IRS audits. And here, this is important. These were no trigger audits, federal audits that the transaction happened to be audited. And inside the transaction, they found the deferred sales trust, and that was then audited. And those were all no change audits as well. There's been private letter ruling as well. On top of the federal IRS no change, no trigger audits, there's also been about 8 state level audits, many being in California. It's no surprise that out there, when you do different research on the deferred sales trust, the folks that don't want you to know about it are the other folks offering a competitive type of thing, like the 1031 exchange. And, I started out in Marcus and Millichap. I love 1031 exchanges. We've helped clients do those for years. And they make a whole lot of sense, especially to maintain the stepped up basis. And especially if you have a nice property to move into. But guess what? A lot of our clients, they're finding us because of a number of reasons. The interest rates are higher now. Cap rates are relatively maybe the same, maybe a little bit higher, meaning the prices haven't changed that much for a lot of especially multifamily owners. And then on top of that, a lot of our clients are to the point where they don't necessarily want to sit through another market cycle and overpay for a property when they can wait on the sidelines and or be passive completely, which leads some people into what's called the Delaware Statutory Trust, which has its pros, but also has its cons. And so cons being you have no liquidity, no diversification, and no control at all. And you're giving up to a third party. We've also done Delaware Statutory Trust. But so the point of all this is there's multiple options and you want to vet each one. But the key is what are you trying to achieve? What kind of freedom are you trying to achieve? What's your goal for your wealth, for your time, for your energy, for your location freedom? And that's where the deferred sales trust is great. Moving on for another part of the topic of the most vetted tax strategy your CPA has never heard of. There's also been audits, and we talked about the audits, the 8 audits of the state and the 14 for the federal, and there's also been promoter audits. Okay, so there's one way to think about it is advisor level audits, and this happened in 2006, 2008, 2017, and 2019, and this is at the advisor level, and those are also no changes. Okay, so the IRS and state authorities are aware of the deferred sales trust. And in fact, even the last 3 or 4 years has been at least 3 California state audits, all no change, no findings. And so we're still batting 1,000. Now, that being said, Jake Miller, why do you think it is still so, people or CPAs are very reluctant to either dig in deeper and or, some flat out say they don't think it works and it won't work and it can't work and all of those type of opinions that are out there, Jake?
What we have to do, Brett, is we have to put ourselves in the shoes of some of these professionals. And again, not to degrade them in any way whatsoever, but if they've not seen something before, they absolutely cannot endorse it. And so if we say, for example, here on the panel, that Pierce York is the owner of a very prestigious tax and accounting firm. And I'm one of Pierce's most important clients. That's why I get the owner, right? Because I'm the most important. So I go to Pierce and I say, Pierce, I heard about this DST. And he's like, Delaware Statutory Trust Fund? No, this deferred sales trust. This deferred what? This deferred sales trust. Have you not heard of this before? I just watched an entire broadcast from Brett Swartz and Jake Miller, and I've learned about all the really cool things that this deferred sales trust can do. Well, immediately, Pierce York, owner of this prestigious tax and accounting firm, is going to be a little bit on the defensive because he doesn't know anything about it. Now, his client, his very important client's coming to him and talking about something that he doesn't know anything about. And first thing that's going to come to his mind is, hey, you know what? I had some other clients go to some dinner seminar with some attorney and they bought them dinner and they pitched them something that was kind of in the gray or something that was unproven. And so this is probably another one of those. So presuming into what he doesn't know. So first, one, a lot of them may not, if they haven't done it for 100 clients yet, they probably don't do it in their firm. You have to understand that a CPA firm, the entire firm, a staff member can't make decisions on what they do and what they don't do, but the owner themselves, they have to evaluate. If I can't rinse and repeat and do this myself, well, I can't invest 100 hours in becoming knowledgeable about it, and I can't invest 10,000 hours in becoming an expert at it. And so, I might see a few pass on the wayside, or maybe I just haven't given it any attention at all. But another client that comes to me who's really, really important, the first thing I'm probably going to say to him is, if I'm being honest, I haven't seen it before. If I'm going to twist the truth a little bit, maybe, hey, I don't know that it's a real thing simply because I haven't seen it before. And then, a little bit further, depending on the ego and the temperament of the individual, they might even say, well, let me Google it real fast and let me give you some answers immediately because Google knows all. And we all know that Google is a collection of a lot of data. Not all of it is correct data. In fact, Brett, there's probably some information out there against the deferred sales trust because there's competitors, people that are promoting 1031s, people who are promoting other strategies, maybe even, the highly contested monetized installment sale and all these other things out there. They might get it confused with our strategy, or, not all information on Google is correct. You have to find a really good source of information, right? And I say all of this, Brett, because I was the back office for a large tax association of CPA firm owners, where I had to be the one to vet a lot of strategies that were brought to the table that these CPA firm owners weren't familiar with. And a lot of times in the process, it was, when does it work and when does it not? Almost always there's cases that were disallowed by the IRS. What does that mean? That means the IRS said, no, this does not work in this scenario. So we had to explain to the CPA firm owners of how to talk to their clients and how to explain to them, hey, this works in this scenario and it doesn't work in that scenario. And if you're going to be the most conservative, this is how you should present it to your clients. We didn't ever have to do that with the deferred sales trust, fortunately, because it's never actually been disallowed. You talked about batting 1,000, Brett, but what I think the general public doesn't understand is that almost never happens. Literally, out of 423 strategies that we vetted for this association of CPA firm owners, there were only two out of all of them that actually bat 1,000. And so the deferred sales trust, luckily, is one of those.
Jake Miller, everybody. That was masterful. Thank you so much. And a couple insights or a couple things I want to just pull out of that even a little bit more. Is the fact that it's okay to not know, but what I would say is the client, it's not okay to just stop that your CPA doesn't know. Bring them to the table. And here's the reality: we work on a conditional basis, meaning we'll work with your CPA. They may have to sign an NDA. Even tax attorneys may sign an NDA. But generally, we can answer the general questions and pretty quickly within about a 15 to 20 minute phone call with the tax attorney CPA who created the structure. their guard goes down and they end up joining us, right? And that's the reality. But there are a lot of things that are out there that are either, misinformation or disinformation or just aren't factual at all, especially coming from qualified intermediaries. They have a lobbying group too. I don't know if people know this, but they have groups that lobby to Congress to make sure that 1031 stands intact. And again, I love 1031. I'm so glad it's there, but oftentimes it creates situations where people are overpaying. They're not diversified. They're taking on debt they don't want to take on, and they want to escape the 1031 exchange. They want more time, energy, freedom to invest when it makes sense for them with new depreciation schedules, or to diversify their wealth out of real estate until the market makes sense. Put it into T-bills, making 4 to 5%. There's all these freedoms of why you'd use the deferred sales trust, and then there's the status quo, why just stay in the 1031 exchange. And so we want you to know that you have options. And by the way, sometimes, Pierce, it's both. You're doing a partial 1031 exchange and a partial deferred sales trust. So talk about that, Pierce. What are the times when we might be doing a partial Delaware 1031, a partial 1031, and then a deferred sales trust?
Yeah, so I think a lot of it has to do with your objectives and your goals too, right? First and foremost, though, one of the things I love about the deferred sales trust is that you can use it with other strategies. It's a cornerstone strategy that you can work other strategies with. And I really like that because it gives you options, it gives you flexibility. In the case of, for example, like a mortgage over basis, right? It'd be a really good idea to use a Delaware zero coupon, a Delaware statutory trust zero coupon deal in order to solve for that problem. In that particular case, right? The difference between what you owe and your basis is taxed at a higher rate at ordinary income, and that Delaware statutory trust can actually solve that. So that's nice. And we can do a partial Delaware statutory trust, and we can do, the rest of it go into a deferred sales trust. You could find a really good property that a 1031 makes a lot of sense for, but it doesn't meet all the replacement criteria that is required by 1031. And so you can do a 1031 and do, maybe a smaller property, and then do the rest into a deferred sales trust and wait until you find something good to go back into. And I mean, there might be a situation where you just really want cash flow in a grade A property that you don't have to deal with at all, and you don't mind paying a little bit higher fees for, zero work, and you just know mailbox money's coming in. It's not guaranteed, but it's really, really close. And a Delaware statutory trust might be a great solution for you, So it gives you the options, right? And so I really like that.
Yeah, well said, Pierce. And so I think the key thing is, what I want to pull out of that too, is it all depends. It all depends on what you're trying to do, where you're trying to do for your wealth, for your time, for your energy, for your risk tolerance. It depends on if you want to be an entrepreneur with your money, if you want to be passive, you want to be retired, you want to be active as a developer. We did a $13 million sale in San Diego for developers who develop car washes, and they didn't want to have to overpay for a 1031. And when they're buying land at a lower value, and have to do equal or greater value. And so part of what we're encouraging you to do, if you're listening to this, is to have what's called a tax flow mindset and not just a cash flow mindset. And when you combine this tax flow and this cash flow together with a team with multiple strategies, or even sometimes the cornerstone, just the deferred sales trust, that's what creates this transformation, this opportunity to have the flexibility. Are there fees? Of course. Can it be seen as expensive? Sure. But we're here to show you how to make it an investment and not an expense, and how to help you and your team that you're working with now have trust and confidence on how we can be part of your team as well. And so what does the deferred sales trust work for is an often question we get. Well, it works for businesses. It works for investment real estate. It can save a failing 1031 exchange. It can also help you solve capital gains tax on a high-end primary home. We did an $8 million sale in Palo Alto for a high-end primary home for one of the top luxury realtors in Palo Alto for 30 years for his own house. And his quote was, "Brett, every single luxury realtor should know about this, because I wish I would have. I'm helping people sell, about 100 million a year in Palo Alto, and they're paying huge tax. I wish I would have known about this 20 years ago." And so it works for stock, cryptocurrency. It works for artwork collectibles. It can work for really anything that is subject to capital gains tax. It also works for short-term holds as well. So it doesn't have to be just a year or more. And so it's sort of like we call it like the Netflix versus the Blockbuster, right? You have much more flexibility. It works for more things. And ultimately, we hope that it can solve the challenges and the things that you're trying to do. So you can go to capitalgainstaxsolutions.com to learn more about that. Let's see, Jake, you want to add or subtract or, pull anything more out of what I just said?
Just making it super, super simple. The acronym KISS, right? So the deferred sales trust defers the recognition of the sale for tax purposes. So just making it as simple as possible, we're deferring the recognition of the sale into the future. You're able to do that because we have this really fancy, nice business trust, which might be different from a grantor trust, might be different from a revocable trust, might be different from every other trust that you've ever seen, because it is a little different. People need to recognize and acknowledge that there are more types of trust than there are flavors of ice cream. So just keeping it simple, this will defer the date of when you actually recognize the taxes that you do owe. You're deferring it forward, and you now have some level of control over when you do recognize it. Often when you take a distribution, you might be recognizing that for tax purposes. And anyway, it puts the control back in your hands, just like your video presentation in the very beginning mentioned.
Yep, exactly. You can invest back into investments of your own or passively. It can be in a diversified portfolio of some of the biggest companies in the world, S&P 500, T-bills. And the key is there's no timing restriction. We do have a question that came in. I want to jump right into that. It's thank you, Heidi. It looks like Heidi from Arizona. At least they hold a property in a vacation rental in Mexico, owned it for about 5 years, paid around $580 for it and made improvements. So the basis is about $600. They are now selling for about $1 million in the area to $1.2 million. Can this strategy be used in this instance? Heidi, the answer is yes. Now the question I think becomes, is it worth it based upon your unique tax situation, based upon your unique wealth goals, and based upon your income needs, and or if you want to spend this money personally all right now? And so let's start with the very last one. If you said to me, Brett, we want to sell, we want to defer the tax, but we want to spend all the money on our primary home or on this boat or on this personal thing, consumption for personal. Well, that's not tax deferrable with the deferred sales trust. Now, can you live off of the interest? Yes, you can defer the tax and live off the interest, pay the tax on whatever you receive in interest payments, but defer the rest of the principal. Now, the second thing would be, is it big enough, right? Is it big enough? So our minimum is 1 million net proceeds, $1 million gain, which I'm seeing right now. If we use 600, 1.2, even after closing costs, let's say it's a $550,000 gain, which would not be big enough for us. However, if you have two assets of 500 or more each that you can combine into one, put it like this, two assets to combine into $1 million net proceeds, $1 million gain, can we combine them? Yes, and that's when it scales. In other words, we can still do it for your sale, but it might only be a single or a double on the ROI, the return on investment, when you go below $1 million net proceeds, $1 million gain per transaction. But as soon as you get above that, we have found that a triple and a home run are achievable financially. Now, have we made exceptions for people because there's something unique there? Yes. Okay. That can make it a triple or home run for your unique circumstances. Yes. But our general rule of thumb is we want $1 million net proceeds, $1 million gain per transaction. However, we are happy to work with you to see if it can be an amazing fit. Part of why we do a conditional basis, right? You also mentioned it looks like you would like to set it up for income and defer the tax. Yeah, that makes sense. So you don't need it necessarily for personal use, at least for the principal. We call that the golden goose. I'm curious what you owe on the property as well. If you could put that in the chat as well, that could be helpful for us, because depending on the debt, we also want to make sure the equity makes sense for what you're deferring. So since it's paid off in full, it looks like there's no debt on the property. And let's say you sold it for $1.2 million. Your gain is about $550. Pierce, I don't know if you can look up New Mexico. I think it's around 5% is the state capital gains tax. I'm not certain on that. So I'm going to start with 20% federal. Go ahead,
I was
Jake.
just going to interrupt. Yeah. So Heidi, this property is actually in Mexico, not New Mexico. So it's a foreign held.
Oh, I missed that. It's in New Mexico. Oh, sorry, it's in Mexico, different country. Sorry
Yeah,
about that.
let's call it Old Mexico. But yes.
It's called Old Mexico. Okay, cool. Right. Okay, so let me back everything up. So if it were in New Mexico, everything what I just said applies, everybody. Okay, that all applies. If it's in Mexico, Mexico has different capital gains tax rules, right? The whole different tax code. So our strategy, the deferred sales trust, applies to anything that's held in the U.S., subject to U.S. capital gains tax. Now, does that mean if you are a Mexican, you're a Mexican citizen or a citizen of Europe or whatever, that you can't use the deferred sales trust? No, not at all. But the asset itself needs to be subject to U.S. capital gains tax. And so being that it's interesting that it's an Arizona LLC, this could be another unique circumstance. Since it's an Arizona LLC, the question would become, well, Heidi, is it subject to U.S. capital gains tax, even though it owns something outside of the U.S.? So yours is kind of complex. We could dig in detail, but if you check with your CPA on the capital gains tax, if it's subject to the U.S. capital gains tax, then we can certainly help you. But if it's not subject to U.S. capital gains tax, then the deferred sales trust would not help you. Jake, you want to clean that up or add to that?
Yeah, I just want to throw out a few different things. So if there is any taxes actually paid in Mexico, which there probably will be for the disposal of an asset, even though it's an asset of a New Mexico LLC, the disposal or the sale of it down in Mexico, those taxes, if you are subject to them and if you pay them, should flow back to you and benefit you as a foreign income tax credit on your U.S. taxes. Now, of course, we try to get around paying taxes. When I say get around, like legally find loopholes that allow us to mitigate those tax ramifications, right? And the treatment of that Mexican asset very likely would also come back to you as capital gains here in the United States. To the point or the extent that it does, then the deferred sales trust may be beneficial to you. And again, it's a cost benefit analysis of what taxes would you otherwise owe compared to the fees and expenses of implementing this program, the deferred sales trust.
Perfect. Very well said. So Heidi, it's worth taking a look at. I'd be curious what your CPA said you're actually going to owe in tax. Have you got if you did nothing, what would you actually pay? Did you 1031? Is this coming from a 1031? It's probably not, because you can't 1031 into property in Mexico. So I imagine you bought it just straight up for 600,000 or so when you bought it, or the 580 plus the improvements. So yeah, it just depends. But now, some of the reasons why I think I wouldn't do it, at least to be honest with you, would be your tax liability is not large enough, right? So what is your exact tax liability? And so if you have 1.2 million, let's say 1.15 after closing cost, how much of that is subject to capital gains tax? And you want to make sure the ratios make sense. In other words, if let's say imagine you had $10 million, but you're only paying $1 million of tax, or 500,000 of tax, it's probably not going to make sense to have to pay fees on 10 million. Now, if you have a $3 million sale and you have $1 million of tax, it's about 33%. That's pretty healthy, right? So I'd want to know, what is your actual tax liability as it pertains to your 1.15 of total equity? I want to look at that ratio. And then I also want to look at the overall, time frame of how and where the funds could be invested, what it could earn, and what that would look like for you. And by the way, if you want to learn more about this, you can go to capitalgainstaxsolutions.com. You can also connect with Jake Meller by going to strategictaxsolutions.com to schedule a one-on-one consultation. All right. We also have some other folks, so I'm going to move on and to see if anyone has any other questions. You can unmute yourself at this time. You can also type into the chat, and we're happy to explore your unique opportunity, your unique deal. And it could be anything about your deal. It could also just be about figuring out the deferred sales trust for the first time. So I see a Mr. Reddy here. Hello. I also see, let's see, we have about 14 people here, it looks like, total. So I'm going to encourage you to, Mr. Cruz, Miss or Mrs. Anderson, say, Heidi, you already said hello. Okay, we're good there. Anyone else that wants to say hello to us or ask a question, you can unmute yourself and put it in the chat.
I do want to close the loop on this New Mexico tax rate. It's 5.9% or $1,000, whatever's higher.
Okay. Right. So let's do that. Let's say 550,000 you have let's call it 6% to be simple there, plus 3.8 for Obamacare. So you're at basically, let's say 10% there. Now you're at another 20, so you're at 30%. So if I had
Nice.
550,000 at 30%, that's 165,000. So think about that. 165 by 1150. If that's the net proceeds, that's about 14%. So it feels a little bit light to me, Heidi. We might work with you to buy some investment real estate and do a cost segregation on that. And because it's only 14%. In other words, maybe we can invest $500,000 or $600,000 into a multifamily syndication with us, and then we can use what's called cost segregation to offset that tax and forego having to do the deferred sales trust at all, and having the rest of that capital tax deferred with you. So that would probably be my initial instinct here for you. Now, if it was 20, 25, 30%, now you're talking a lot of tax on of this as a percentage of your total equity. Then I think it makes more sense, Heidi. Heidi, you want to unmute yourself because we're happy to walk you through that. Hopefully that's making some sense here.
Yeah, sorry, I didn't know that I could. It probably would be easier to talk. I'm actually in Arizona, not New Mexico, and it's an Arizona LLC, and the property is in Mexico. So, but and it's not subject to Mexican capital gains because it is in the Arizona LLC, and my accountant down there has already confirmed that. But I mean, it does sound interesting too, and we're not selling it tomorrow. I mean, this is something we're planning. That did you say in 2025 that the capital gains there's going to be a difference
at the end of 2025 as we go into 2026? The job cuts and the tax cuts and jobs. Oh, I'm getting that all mixed up. President Trump's Tax Cuts and Jobs Act sunsets.
Expires,
so
yeah.
Those decreased capital gains tax rates of 20% will go up to 28 unless legislation changes it to something else. But the default is to be reset to what it was in 2017.
And Arizona is 4.65, so it's basically it's a little bit lower. So you'd have 4.65 for the state, Heidi, and then you have 20% for federal, and then you'd have another 3.8 probably for Obamacare. So you're looking at probably like blended about 28% or so, give or take. So it's still pretty substantial. But again, we would work with you to do probably an alternative structure there. So I'm happy to work with you on that as well.
Yeah, I'm that's what we were just trying to figure out, is kind of like what's next, like what can we do with the money once we do sell it, and we are thinking like in the next couple of years, so it would be before the 2025 expiration of
yeah
that.
And the other reason you want to do it this year is this what's called bonus depreciation that accelerates. It's 80% this year, it was 100% next year or last year, and then next year it's going to 60. And it's going to wind down to 40 and 20 and then eventually phase out unless they re-up them. So one reason why to sell right now is to be able to do bonus depreciation as long as you can be passive. So there's a number of things, Heidi, here. But yeah, if you want to schedule a time with us, we're happy to walk you through it and help you out.
Okay. Yeah, it's like I said, I don't. We love the place and we love going there, but it's just getting more and more complicated to do business down there.
Sure. Jake knows well. Jake's doing some business down in Colombia, and he's got a lot. He knows it very well.
Yeah. And Heidi, it's been a while. How are you and your husband doing?
We're doing great. We're doing great. It just actually, because I think we had a 1-bedroom condo down there, which we just sold. And I did a installment sale on that. So I've got that figured out as far as the capital gains, because that's not nearly the amount of money. Our gain on that was about 150,000.
Good.
But I'm able to spread that over 5 years. So
very
excellent.
Good. Well, let's look at this other deal offline a little bit more closely, and we'll see if we can get out there.
Okay. Thanks,
Great.
Jake.
Yeah,
we actually have someone else here that has property and different things in Mexico. Pep, I don't know if you're able to say hello. I know you're in 2 meetings at once right now. We got Pep Catcher, who's also Arizona and down in Guadalajara.
Yeah, I'm living down in Guadalajara. We have a brewery down here along with co-packing plant and some other ventures that we're looking at. But I'm also an Arizona resident and a Scottsdale resident, and it's been a pleasure getting to know Jake. He's been more than informative. I thought I knew everything about Mexico and international business, and now I've been schooled tenfold. Really, it's been a pleasure. But highly recommend anything that Jake is working on.
Appreciate that, Pep. That was nice.
Very good. Who else? Do we have anyone else? We have a couple of Edward, thanks for joining. Happy to answer any questions. We're in the live question Q&A here. You want to say hello?
Hello, everyone.
Hey, how are you?
Just I've been on one other call before. We talked about a few things, so
Yeah.
just wanted to get caught up again. So
Good to see you. Good to see you. Well, welcome back. Good. And looks like is it Miss or Mrs. Brian Osborne? Hello as well. I'm not sure I recognize, but welcome. And we have Jesse. And is it, oh, you say Mr. Reddy? Yeah. So anyone else has any questions or thoughts, feel free to unmute and say hello or type it in the chat. We are here. We're talking about the most vetted tax, the most vetted tax strategy your CPA has never heard of, deferred sales trust. And we're talking about how to help people escape feeling trapped by capital gains tax, escape the 1031 exchange, and defer tax, build wealth. So we are happy to talk with anybody. And Pierce, maybe we'll talk about how the ICSC went. What were some of your takeaways, and talk about what it is, and maybe some people you were able to talk to about the DST there.
Sure. So ICSC is a huge conference, then multiple conferences every year, mainly focused on commercial, retail, a lot of developers, a lot of city economic development planning committees attend, a lot of brokers attend, your typical retail people, your franchises, your Taco Bells, McDonald's, Jiffy Lubes, kind of like all get together and they just try and put together meetings and deals, advertise their things and all that kind of stuff. So it was huge. It was a massive conference. It was in Las Vegas. Very good conference. There's a lot of really good people there, a lot of really good contacts. And the people that were the most interested in our, and in the deferred sales trust, I would say would be the developers. A lot of them are buying lots, right? Entitling them, building, and then they turn around and they stabilize and lease it up and then they sell. And when they do that, they do not want to, typically they don't really A, want to do a 1031, or B, they can't because of the way they structured their stuff, or they have to go buy another really expensive building instead of go buy a lot that they want to redevelop. So they really liked our I used our car wash deal a lot there, that deal story. So that seemed to really drive home the point, and they were very interested in that. So now it's following up with them, and getting them to kind of come on. I'm going to invite all of them to the calls from now on. So that'll be good. But yeah, it was an awesome conference. The, the sentiment from a market perspective is everyone's crystal ball is broken and in the shop, right? So no one actually knows what's going to happen. Deals are still being done. Obviously, they've slowed down drastically. Interest rates are still super high, and they are making some deals not pencil. But that doesn't mean that deals aren't getting done. And so it's conservative underwriting. It's, cap rates are starting to decompress a little bit. And so from a macro perspective, people are still moving, but they are definitely more hesitant, slowing down a little bit, and just being a little bit more conservative in their underwriting.
Well said. Good overview, Pierce. Yeah, and so to bring that full circle with the developers, what you can do with the deferred sales trust, and the reason many of them don't use a 1031 exchange is just by definition they are building something that's less value and building it up, whereas a 1031 forces you to take the excess value and move it into another asset of equal or greater value. So the San Diego development was a $13 million total development exit price, which means they automatically would, if they were to do a 1031 exchange, have to buy something of 13 million or more, or a couple of assets that equaled 13 million. Well, they had bought the land for about 500,000 to $1 million. They had developed it for another like 3 million. So their total cost was about $4 million. That's their model. Their model is to buy land cheaper, develop it over time, build a business on it, then sell it for 13. So with the deferred sales trust, and by the way, they had debt along the way as well. They're able to retire debt at optimal time. They're able to defer the tax at about 40% collectively. And now they have this pile of cash that can buy land at a discount, hopefully in this upcoming year, and use it to develop a project. In other words, use the money for what they really want to use it for, all tax deferred. And so developers are really great for, the deferred sales trust is really great for the developers because it helps them to keep an extra, call it 30 to 50% working for them. And if you think about it, 50%, that means every 2 deals they do, it's like they get, do 2, get 1 free, right? That's a neat way to think about it, just as the ROI perspective. So again, go to capitalgainstaxers.com to learn more about this. Appreciate the overview, Pierce, for ICSC. That's all I really have for today. Jake Miller, you want to add anything else to the mastermind here before we let you get to some of the cooler stuff that you can be doing right now in Amsterdam?
No, I think I just let a lot of people know and understand that this deferred sales trust is not just for real estate. It's not just for the sale of your business, but it could be for any highly appreciated asset that you have that you're looking to sell. And again, an easy rule of thumb, and there are exceptions, but an easy rule of thumb is that should you be subject to pay taxes, capital gains taxes on at least $1 million, which that might mean that you have a $2 million transaction, 1 million basis, so $1 million above basis, which is what you're going to be taxed on, right? So you've got at least 200,000 or greater tax paying, then it's a no-brainer. I mean, that's what we look for. Something like that. Anything less than that, then we have to do some calculations. We have to measure the tax paying to see if it's sufficient for us to implement the deferred sales trust. But anything over that, it's an easy deal. The other caveats that we measure, we look into to see and make sure that this is not only that you're eligible, but this is the appropriate strategy out of so many strategies out there, is what your goals and objectives are with the proceeds of the funds. If you're looking to take those proceeds and reinvest them in other assets or otherwise diversify your current holdings, this is a perfectly appropriate vehicle. If you are like that one client of mine who went and spent 3.5 million on a Lamborghini without it being any business purpose whatsoever, that's just a taxable distribution. And of course, if you have questions about how to navigate the waters of the deferred sales trust, that's why we have our recommended and trusted trustee. That's Brett Swartz. That's why you have the law firm and the legal team behind us that help make this strategy a bulletproof strategy, should we stay within the guardrails and not abuse it. And of course, we're here to help you with the financial directioning and letting you know what your options really are. So let's have a discussion. Let's all get together and let's explore what your options are.
Perfect. Jake, where can people find you if they want to find you?
Should you have questions or have an eligible sale, reach out. You can look at it. You can find us on strategictaxsolutions.com, which is my website, as well as Brett. You have a website that sounds very similar, right?
Yeah, I'm at capitalgainstaxsolutions.com, and you can also check out the new book that just got released. I encourage you to pick it up on Amazon. It's called Building a Capital Gains Tax Exit Plan. We do have the Jake Miller in the book, and I have a couple chapters, and we have Kevin Harrington from Shark Tank in the book too, which is pretty cool. And we hit #1 bestseller on real estate and wealth categories on Amazon. Pretty cool. So it's all about the journey, my journey, and others' journey to the deferred sales trust. Another journey about building wealth. Investments in real estate and securities, different things. Amazing. Check out Building a Capital Gains Tax Solution, Building a Capital Gains Tax Exit Plan, not to be confused with Capital Gains Tax Solutions, which is the website. All right. That being said, Pierce, where people can find you if they want to get in touch with you.
Yeah, you can find me at Living in Newport Beach, California YouTube channel, or KingdomLuxuryRealty.com.
Awesome. Thanks, everybody. Have a great week.